Hello everyone, my name is Ashish Somaiya and I am the Managing Director and CEO for Motilal Oswal Asset Management Company. I am here to talk to you today about why we think investors who are investing in equity markets, why do they need professional advice or why do they need support of professional management. And at the same time, I'll also be discussing the role of investment advisors in the entire investment process. So I'll start off by giving you one such example. And one of our all-time favorite movies is Munna Bhai MBBS, and obviously Mr. Boman Irani is a favorite of most of the people who follow Bollywood. In that extremely popular movie, when he is teaching a medical class, he actually comes up and says that when I'm the best surgeon in the world and I have a rock steady hand when it comes to performing surgeries on the entire world. But when it comes to operating my own daughter, I'm not sure if my hand will remain rock steady. And I think it came across as while watching a movie, it just comes across as an innocuous statement. It just comes across as if some doctor is talking something, but it's a pretty deep message. Basically, what it says is that one needs to be able to control one's emotions. When I'm giving advice to you, when I'm giving advice to 20 other people, when I'm managing money for a lot of other people, I do it as my profession, and that is what I'm trained for. But when it comes to actually managing my own money, am I as unemotional? Am I as dispassionate? I think that is something to be thought about. And here we always give this very, very common example. Let's say that you as an investor have actually bought 2 shares, both at a price of 100 rupees. And normally we make equity investments for the long term, but obviously there are times when you may need money. So let's say you bought shares of 2 different companies, each for 100 rupees. And after a couple of years of making that investment, you actually feel the need for money. When you go back to evaluate the position of your investments, you find that one of the shares which you bought has traveled from 100 and the value has become 150. And the other share which you bought, the value which you bought at 100 has actually depreciated to 80. And now you need about, say, 50 rupees. So which one are you most likely to sell? The one which moved from 100 to 150 or the one which depreciated from 100 to 80? Which one are you most likely to sell? I don't have a mechanism to take your answers now, but my experience of dealing with a lot of people tells me, my experience of dealing in my personal investments also, it actually tells me that all of us are most likely to book profit on the item which moved from 100 to 150, and most unlikely that we'll actually sell the item which moved from 100 to 80, because that's going to result in a loss. Now the whole point is that this is the entire benefit of having a third party opinion or having a third party managing your investments, because when you manage it yourself, you tend to have emotional reactions. In reality, 100 becoming 150 or 100 becoming 80 has nothing to do with the selling decision. When you actually go back to evaluate, you should be seeing whether the item which was 150, does it have to have the potential to become 200, or the item which was at 80, does it have the potential to make 80 into even 50, 40 or 30. I think that's the single deciding factor. One must keep in mind that financial wealth or financial health is as important as physical health. And here again, I always, like I said, draw some inspiration again from Bollywood. The very famous dialogue which is mentioned in one of the movies. And I always ask this question to people, that when your medical health is not in the right shape, you know that you should go to a doctor. But when your financial health is not in right shape, normally you come to know much late, and do you even know who to go to? So what happens if your medical health is not fine, and what happens if your financial health is not fine? When your medical health is not doing okay, in the worst case, of course, we will die. But when your financial health is not okay, you will definitely not die, you will live, but you will live a painful life. And this is very well captured in one of the Bollywood dialogues, because what it says is that zillat ki zindagi se izzat ki maut behtar hoti hai. So as usual, it's a slightly exaggerated kind of statement, but I think that when it comes to medical health, you don't do it yourself or the online way. And the same perspective, I don't think you are an expert yourself at all points in time. So as far as financial health is also concerned, you may ultimately execute the transaction online because you find that more convenient. But the whole point is that you will definitely need a financial advisor to tell you what the right thing for you is. Coming on to the third point, in terms of role of investment advisors, I think this entire financial domain, financial planning domain is reasonably complicated. It's not easy. It's not everybody's cup of tea. to figure out that what exactly is the financial requirements over a period of time, in the next 10 years, 15 years, 20 years, and 30 years. In fact, I meet a lot of people and I ask them this very, very simple question. I'm not an expert on financial planning, but if we were to walk out of this place and generally catch 100 people and do a survey and ask each one of those 100 people that, okay, look, for some particular financial goal, you need to have 10 lakh rupees in the next 5 years. At the end of 5 years from now, you need to have 10 lakh rupees. And you are able to start with, let us say, 5 lakhs right now. Or let us say, yeah, you're able to start with 5 lakhs right now. So what it means is that 5 lakhs need to become 10 lakhs in the next 5 years. So where should you invest? And what kind of rate of return do you require? Now, this comes across very simple, but actually most people don't know how to calculate this. Because if 5 lakhs has to become 10 lakhs in the next 5 years, which is a doubling of money in the next 5 years, then the least return you need is 15% compounded. And I don't think there is any asset class other than equities which can accept 5 lakh rupees and also leave you with a reasonable potential of making it 10 lakhs in the next 5 years. A lot of times people go about huge decision processes that, okay, I'll put these 5 lakh rupees into deposits, I'll put these 5 lakh rupees into this bond, I'll buy this instrument, I'll buy that instrument. People do a lot of planning, but what they don't realize is that if you need 15% for the next 5 years compounded, it's not that equity is going to assure you that, but the only asset class which has even the potential of getting close to it is equity. Now, what I narrated to you is a very simple calculation, but most people can't do it. And let me tell you, this is the simplest calculation in financial planning, and I don't think most people can do it. And we expect that we will ourselves be able to forecast that, if I'm going to retire at 65, what is the cost of living going to be? How much money do I need? How much should I save right now? What are the different goals or milestones along the way? This is purely a professional's job. I think people take it, genuinely, I think people take it very, very casually. And I think if they are going to be able to do this themselves by logging onto some website, then, God help them. So these are, few very simple reasons I have shared with why investment advisors have a very, very large role to play in the financial life of individuals. And my personal opinion is that as of now, most investors are taking their entire financial well-being quite casually. I don't think it is something to be taken casually. Please remember the dialogue from this Bollywood movie I just shared with you. It's extremely important. Always keep it in mind. Moving on to the second part, which I wanted to share with you. So the first part that I mentioned is about the role of investment advisors in the financial life of investors. And the second thing which I wanted to share with you is also about the role of asset managers or role of portfolio managers or, professional help when it comes to managing equity portfolios. Because this is the second area I have seen where people like to do it themselves. I meet a lot of investors who, dabble into stocks. And at the same time, they have this entire belief that when they meet portfolio managers like us, they're just interested in knowing how we manage money and what we are buying rather than engaging the services of a professional manager. So why should you invest in mutual funds instead of investing yourself? Or why should you engage a portfolio management service instead of managing money yourself? And here, before I start, I'm going to share a couple of very important examples with you. These are purely, newspaper clippings. And in the next couple of moments, you will see these newspaper clippings and you will see what I'm trying to say for yourself. But recently, a lot of people told me that, in the last 6 years, suddenly there is, last 6 years, market didn't move anywhere from 2007 till 2013. There was no movement. I mean, the Nifty at the peak was 21,000. Sorry, Sensex at the peak was 21,000, fell all the way to 8,000, went back to 21,000. And there is, in the last 1 year, there has been a lot of euphoria. But still, people don't seem to be making enough money and retail participation doesn't seem to be improving. So what is the euphoria about? These are the kind of questions people ask. So I just went back to the drawing board and I kind of did some analysis. And I'll share with you what I realized. So in the last 5 years, say 2008 onwards, from bottom till now, some of the best performing stocks are ones like Sun Pharma, HCL Technologies, Eicher Motors, Page Industries. A lot of these companies have given stupendous, Hindustan Unilever, ITC, a lot of these companies have given stupendous performance. On the other hand, there are a lot of companies, which were extremely popular in the previous bull cycle, but they haven't recovered yet. So let us say the big ones like Reliance Industries, Reliance Communication, DLF, a lot of these companies. And I was figuring out that if there are equal number of companies which have given fantastic returns, and then there are these other set of companies which have not given great returns, why is it that people are still not making money? What is the issue? And then I hit upon this very interesting data which actually told me that Reliance Industries has 21 lakh shareholders. Reliance Communication has about 19 lakh shareholders. DLF has just under 5 lakh shareholders. What I'm sharing with you is data as of 30th June, and the source is Capital Line. So I've given you 3 examples where the market cap of these companies is around 30, 40, 50, 60% lower than where it was in the peak. And the total I've given you is about 45 lakh people who are holding these shares, and the value hasn't yet recovered. On the other hand, I gave you examples that people have made a lot of money in say Sun Pharma and HCL Tech. But how many I thought, let me check how many shareholders does Sun Pharma have. So in March 2008, Sun Pharma had approximately 30,000 shareholders, and June 2014, June 30th, 2014, Sun Pharma has approximately 1.3 lakh shareholders. The number for HCL Technologies as of June 30th, 2014 is 89,000 shareholders. So what we are talking about in terms of people making money is that there are about 45 to 50 lakh people whose money is still underwater, and the people who have made money is in few thousands. And the interesting part is that in 2008, Arcom was part of Nifty. In 2014, Arcom is no longer part of Nifty, but yes, Sun Pharma is part of Nifty. And I think somewhere in the recent past, even Eicher Motors was, I think it's being included into the index. So the interesting part is that if there are millions of people whose money is underwater, and there are few thousands who have made stupendous returns, obviously there will be lack of conviction. But the whole point is that what do we buy versus what do investors buy? What did professionals buy versus what did investors buy? And here I would like to draw your attention to some of our portfolios. You can log into our website and you can check our investment portfolios, and you can check what stocks we are holding. The newspaper clippings that I saw in the last 3 days, there was this very cheerful announcement in the front page of Business Line a couple of days back, which actually says that retail investors are coming back into the markets, and there are some 190 different firms where retail holding has actually gone up. So I said, oh wow, retail investors are back. Let me just check what kind of list it is. And I was actually not surprised to know that none of the Nifty companies are making into the list. The entire list is full of companies which in a moment we'll show you that clipping right here. Yeah, so if you've seen that clipping, you will realize what kind of companies retail holdings have actually gone up. And then there was this another clipping which actually told me that there has been a big rally in small and mid caps, but investors were not able to participate because the shares were suspended or delisted. And then I said, okay, let me see, what kind of shares are suspended. Typically shares get suspended from exchanges if they don't file their quarterly results, if they don't file their shareholding patterns, etc. And here we are now going to share with you a list of companies, how many shareholders they have, and these are the companies which got suspended, so people couldn't, there's no movement in the share price. So you can have a look at the clipping. And here again, I'm sure you would have noticed that the topmost company has more than 4 lakh shareholders, which is much more than even the number of shareholders I told you for a company like Sun Pharma or Eicher or HCL Technologies. So what I find interesting is that investors, when they are themselves buying stocks, they have what we call a shampoo sachet kind of mentality. You know why, right? I mean, if you buy shampoo, the bottle costs 100 rupees. But a lot of these shampoo companies, they actually make larger business by selling sachet for 2 rupees. The logic is that people are very happy to buy a sachet for 2 rupees. And if you actually do the grammage and multiply it by the cost of the unit price of the sachet, you will find that the cost is almost 2 times. The same logic applies to shares. People love to buy something trading at 5 rupees, but they will never touch anything which is trading at 10,000 rupees. Because people don't understand the market cap and dilution related concept. If there is something which is trading at 5 rupees but has 1 crore outstanding shares versus something trading at 10,000 rupees but has only 1 lakh outstanding shares, then the market cap, the earnings and the dilution is two completely different things. So people just have this sachet mentality. They love to buy what is cheap, They love to buy what is popular, but more often than not, what is cheap for a reason and deserves to be cheap for a variety of reasons. Whereas more often than not, what is perceived to be expensive may not be really expensive. When you are buying shares, ultimately you are buying the earnings and the dividends which are likely to come through in the future. It's not just the unit price that you're concerned with. And in very simplistic terms, a lot of times people don't understand the concept of PE ratios as well. One needs to be focused on the earnings. And I give this very common example at all points in time. Let's say that there are, when summer comes, people buy mangoes. Let's say there are 2 cartons of mangoes, each with one dozen mangoes kept in it. There's one carton here which is available for 500 rupees a dozen, and there's another carton here which is for 800 rupees a dozen. So I ask investors, which one is more expensive, and obviously the logical answer is 800 is more expensive. But the whole point is that you need some more data from me. If I were to tell you that eventually mangoes are converted to pulp, and the carton which is going for 500 rupees a dozen, you can get 8 glasses of pulp from 1 dozen, and the carton which is going 800 rupees a dozen, you can get 18 glasses of pulp from 1 dozen. So which one is more expensive now? So that's the whole point. There may be a stock trading at 10,000 rupees with an EPS of say 100 rupees a share, and there may be a stock trading for 5 rupees with the company going into losses. The whole point is that people would prefer to buy the stock trading at 5 rupees because they have a sachet mentality, whereas people are least likely to buy the stock trading at 10,000 rupees because they have this, because they find that it's expensive. So this is clearly where professional management is extremely important, because buying companies is singularly about trying to estimate the earnings and the likely earnings growth in future. And I don't think that very many people are absolutely capable of doing this analysis on their own. And it's very important in the long run, like I've shared in a couple of other videos of mine before this, it's extremely important to understand that in the long run, wealth is created by buying good quality companies and riding the entire growth curve. That's why we always advertise buy right, sit tight. A lot of times what happens if in the absence of professional advice, if people buy right, they tend to book profits, and people buy cheap stocks and then they sit tight and they become long-term investors. So this is something which we've discussed before, so I'm not going to repeat it. But I think professional management is extremely key. There's just one last data point which I wanted to share with you apart from those clippings that you have seen. Just one last data point I wanted to share with you when it comes to the need for professional advice. If you take the entire market cap, as we speak now, the total market cap of our equity market is about 90 lakh crores, or should be about 90 to 92 lakh crores. Out of this, 55% is owned by promoters, 25% is owned by FIIs, about say 10% is owned by different institutions, and about 10 to 12% is owned by what we call non-promoter, non-institutional, that is retail holding. So this is on the entire stock market capitalization. So like I said, keep 2 numbers in mind. In the entire market cap, FIIs are about 25% and retail holding is about 12%. But what should this number be if you look at the best quality companies in India? When you see best quality companies in India, they are part of Nifty, the 50 best companies. In fact, out of the 90 or 92 lakh crore which I told you, just under 50 lakh crore is composed of Nifty. So the top 50 companies are more than half the market cap, and then there is a long tail of some thousands of companies which are the other half. So the interesting point for us to understand, whether people are buying the right stocks or not, whether people are buying the right quality companies or not. I said that in the entire market cap, FIIs are 25% and retail is about 10 to 12%. When you look at Nifty specifically, take a wild guess what the non-promoter, non-institution holding should be. What is retail holding in Nifty? In the entire market, it's 10 to 12%. But what is retail holding in Nifty? You'll be surprised to know it's 4%. And what is retail holding what is FII holding in Nifty? It's approximately between 27 to 28%. Now, if you analyze the entire market cap and take various cuts, when you take Nifty, you are likely to find that FIIs are about 27 to 28% and retail is about 4%. You move from Nifty to BSE 200, you will again find that FIIs are about 27 to 28% and retail holding is somewhere in the range of 5 or 6%. If you actually move on to CNX 500, you will find that FII holding drops all the way to 22% and retail holding actually goes up to about 8 or 9%. So what this data actually tells you is that as you go down on quality, retail holding goes up and FI holding goes down. And as you go up on quality, FI holding goes up and retail holding goes down. And the reason for this is exactly what I told you, that retail investors or people who are buying stocks directly without consult, without going through a portfolio manager or without actually going through the right investment advisor. Your investment advisor could be your stockbroker also, or anybody. If you're not consulting a professional, if you're not going for mutual funds, if you don't have an investment advisor, if you don't have a professional PMS service provider, you're most likely to buy something cheap, which you perceive as cheap, and hence you go that much away from buying quality. So I think these are some very, very important lessons that one needs to keep in mind. Thank you very much for giving me a patient listening. As always, be in equity, be with Motilal Oswal, buy right and sit tight. Thank you very much.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.